Every dollar in your traditional IRA or 401k has a tax bill attached to it that hasn't been paid yet. Somebody eventually pays that bill, either you at a rate you can see today or whoever inherits the account at a rate nobody can predict. For years, if you talk to a financial advisor about converting to a Roth, you probably heard a different warning instead. Do it before 2026. Tax rates are scheduled to go up, so lock in today's rates while they're low. The reason doesn't exist anymore. Under current law, those lower tax rates are no longer scheduled to expire. So if the whole argument for converting was a deadline, that deadline is gone, which means much of the recent conversations around Roth conversions is built on a reason that no longer applies. But that doesn't mean you should stop thinking about it. It means the real reason to convert was never about the deadline. It was always about who pays this tax and when. For context, I grew up around family-owned businesses, heating oil, excavation, and auto body shops. I started my own landscaping company as a teenager. Today, I spend most of my time helping business owners coordinate taxes, retirement planning, and long-term wealth decisions. And Roth conversions come up in almost every one of those conversations, usually for the wrong reason. People ask about it because they heard a rate hike was coming. Now that it isn't, does the strategy still matter? It matters more, and it's actually more useful to you than the version you were sold. Let me show you why. For a few years, there was a real deadline attached to this conversation. The tax brackets that came out of the 2017 tax law were scheduled to expire. If they expired, rates were going to set back up to where they were before. So the advice made sense at the time. Convert now while the government has told you exactly what today's rate is, because it might not stay that way. Then the law changed again. Those brackets didn't expire. No sunset, no scheduled increase. The rate you're looking at right now isn't a temporary window anymore. It's just a rate. So the urgency is gone. I've had more than one client bring this up, almost apologetically, like they'd missed some closing window. Matt, did I wait too long? Is it too late now that the rates aren't going away? And my answer surprises most of them. You didn't miss anything. The thing you were worried about missing was never actually the point. Advisors built an entire industry around that deadline for a few years because a countdown is an easy thing to market. It creates urgency. It gets people to act. But a countdown clock isn't a strategy. It's a marketing device attached to a strategy that was already worth doing on its own. The rate being locked into current law doesn't mean converting stopped making sense. It means we can finally talk about the actual reason to do it without a fake deadline hanging over the conversation. Here's the simplest way I explain a Roth conversion to a client. The money in your traditional IRA or 401k has never been taxed. You got a deduction when it went in. It grew tax deferred, and at some point, the tax comes due. Either you pay it when you pull the money out, or whoever inherits the account pays it when they pull the money out. That tax bill isn't optional. It's just unscheduled. Somebody pays it eventually. The conversion is you choosing to pay that income tax now on your terms at a rate you can actually see, instead of leaving it as an open question for future you or for your family. And if you're listening to this and realizing nobody has ever actually walked you through that choice, whether you should be paying this tax now instead of leaving it open, that's exactly the kind of thing we talked through in an introductory meeting. We'll look at your business, your income picture, and where conversion actually makes sense for you. But let's keep going, because there's more to this than just choosing to pay now. So why would you volunteer to pay tax early? Because of what you get in return. Once you've paid that tax at conversion, that money is done being taxed. It grows from that point forward with no future income tax attached to it. When you use it in retirement, it comes out clean. And this is the part that matters most to the business owners I work with. When you leave a Roth to your family, they inherit an asset that isn't carrying a future income tax bill they have to empty that's already been taken care of. One of those shows up as a tax bill, often right when your kids are in their own highest earning years. The other one doesn't. So the real reason to convert was never rates are about to jump. It was always, I'd rather choose when and at what rate this money gets taxed instead of leaving it to chance. And once you're thinking about it that way, a very specific opportunity opens up. And this is the part that's almost tailor-made for business owners. If you're an employee, your income is basically the same every year. You get a paycheck. It doesn't swing wildly from January to December. That means your tax bracket is pretty predictable year after year. Business owners don't have that problem. Or depending how you look at it, business owners get an advantage, employees don't. Your income moves with the business. A strong year looks nothing like a slow year. And every so often, you end up with a year where your taxable income is unusually low. Maybe the business had a rough stretch. Maybe you made a large deductible purchase or investment that pulled your taxable income way down. Maybe you sold one business and haven't started drawing income from the next one yet. Any year where your income temporarily drops below normal is a year where converting costs you less, because the tax you pay on a conversion is based on your income that year. Convert in a normal year, you pay at your normal rate. Convert in a down year, you pay the lower one on the exact same conversion, same account, different bill, just because of when you did it. That's the whole game. And it's the piece almost nobody tells business owners to watch for. Take that space between selling one business and ramping up to the next one. For that stretch, your taxable income can be dramatically lower than what you're used to, which means you have room to move retirement dollars into a Roth while you're sitting in a lower bracket than you'll likely see again once the next venture takes off. Most people never even notice that window is open. They're focused on the transition itself, the sale, the next opportunity, the logistics. Nobody's looking at the tax return and asking whether this is the cheapest year they'll ever have to move money into a Roth. I think about it in terms of two business owners, both selling a company in the same year. The first one sells, immediately reinvests into a new venture, and starts drawing income again within a few months. The second one sells, takes real time before jumping into the next thing, maybe a year, maybe longer. Same transaction, same amount of money in the bank, completely different tax picture. The first owner never really has a low income year. The business income just continues, mostly uninterrupted. The second owner has something the first one doesn't, a genuine stretch where taxable income drops well below normal. That stretch won't last. The next venture, the next investment, the next chapter eventually brings the income back up. But while it's open, converting retirement dollars into a Roth costs less than it will at almost any other point in that owner's life. And it doesn't only happen around a sale. A year with a big equipment purchase, a year you funded a large deduction, a slow year you'd otherwise want to forget. From a planning standpoint, a down year isn't just something to survive. It can be one of the most valuable tax years you'll ever have. If someone's actually watching for it, that's exactly the kind of opportunity that gets missed when tax planning only happens once a year at filing time. By the time your filing that year is already over, you can't go back and use it. This is why I tell clients your income needs to get looked at during the year, not just reported after it. The whole point is to catch the low year while you can still do something about it. I want to be clear about something, because Roth conversions get oversold constantly. This isn't free money. You're paying tax today that you would have otherwise deferred into the future. For some people, in the right year, that trade is excellent. For others, it isn't. The conversion itself isn't the goal. The goal is making sure this money gets taxed once, on purpose, in a year you chose at a rate you could see coming. That's a conversion that has to include your CPA, because the right amount to convert in any given year depends entirely on your actual tax return that year, not a generic rule of thumb. The right conversion amount is never a guess. It's a number your CPA and your advisor land on together, based on your real income that specific year. There are a few situations where I actually slow clients down on this instead of speeding them up. If you're going to need those dollars for living expenses in the next several years, paying tax on them today just to convert them can create a cash flow squeeze that isn't worth it. If this genuinely isn't a low income year for you, converting at your normal higher rate can undo a lot of the advantage we're trying to create in the first place. None of that means Roth conversions are the wrong strategy. It means timing and amount matter as much as the decision itself, and neither one should be decided from a video, a podcast, or a conversation with a friend at a conference. And look, every situation is different, so don't make planning decisions based on a YouTube video. Run ideas by your own advisors. Or if you'd like a second opinion, schedule some time on my calendar below. Look, the old pitch for Roth conversions is genuinely dead. Nobody needs to convert because the deadline is about to hit. But the real reason was never the deadline. It was always about choosing when this money gets taxed and at what rate, instead of leaving it to whatever your income happens to be later, or whatever your family's income happens to be when they inherit it. The tax rate not changing isn't a reason to stop thinking about this. It's the first time in years you've actually known what you're working with. If you take one thing away from this video, let it be this. Stop asking whether rates are about to go up. Start asking whether this is a year your own rate is temporarily low, because that's conversion actually pays off. For a lot of business owners, especially after a sale, a slow stretch, or a big deductible year, the answer is yes, and most of them never realize it in time to use it. For others, it isn't the right year, and that's exactly why this isn't a decision to make from a video. If you'd like a second set of eyes on your own situation, use the link below to see where your tax strategy stands. Free, about 5 minutes based on your actual numbers. We'll figure out whether this is one of the years worth using, because the deadline that used to drive this conversation is gone. What's left is one of the most important reasons business owners should still be thinking about Roth conversions.